Okay, this is the third problem in Procopy, and it's Tercero Company, and they sold 42,000 units in 2025. The manager did not find any variable cost variances, and the actual production equaled budgeted production, so we don't need any volume variance, okay, 40,000 units. Beginning inventory for the year was 3,500 units, and last period's inventory carried the same cost per unit as this year's production. So, otherwise you'd have 3,500 units at, say, $20 a unit, and then everything after that maybe 22. You see what I mean? And you have to use like a LIFO assumption to go forward. The company's income statement used for internal reporting shows the following. So internal reporting would be variable cost. And we've got sales less variable expenses. So you can think of this is variable cost of goods sold. Okay, and variable operating expenses, typically selling expenses, are in here. 27.3, so there's my total expense and contribution margin. Less fixed expenses, these are fixed manufacturing expenses and fixed operating expenses. Okay, 20,000 and 14,000 for a total of 34, and operating income is for 37,400. And the CEO wants to determine operating income under absorption costing, and your job is to prepare an absorption costing statement. Now, what's important, the reason why a CEO might want this is everybody always wants to know what it's going to look like in the external financial statements. And a variable cost statement won't tell you that. So you would manage by variable cost, okay, but you got to be aware of what's going on with absorption costing, because those are your costs that are going public, okay? So let's take a look. Sorry. Let's see. Whoops. Okay, so here's our beginning. Here's our beginning inventory is 3,500 units. Oops. We produced 40,000, so we've got a total available of 43,500. We sold 42,000, right? Yeah, sold 42,000. Yeah, 3,500 beginning. Produced 40,000, so 43,500 is available. We sold 42, so our ending inventory is 1,500 units. Okay, cost of goods sold. What do we have here? Cost of goods sold. This is our original statement here. No, it isn't. This is the final one. Cost of goods sold would be, this was variable cost of goods sold. 100,800 divided by the 42,000 sold units would give us $2.40 per unit of variable manufacturing costs. And then fixed manufacturing would be the 20,000 divided by the 40,000 budgeted production. Okay, this would be budget. So that would be charged with 50 cents per unit of fixed manufacturing overhead. So our actual fixed manufacturing overhead cost per unit, or our actual cost of goods sold per unit rather, the two together, that's variable and this is fixed, is $2.90. Okay, and then they sold 42,000 units, so cost of goods sold on an absorption basis would be $121,800. Okay. Okay, so what do we have? So that gives us sales of $199,500. Cost of goods sold is $121,800. So our gross margin is $77,500. Then we've got to figure out operating income. So this will include both fixed and variable also. And that would be 27.3. So 27.3. Here we are. It's down in the bottom here. 27.3. Our variable operating cost 27.3 plus fixed operating is 14,000. So the total operating expense would be 41.3. Okay. So operating income on an absorption basis would be 36.4. Just one last thing here. I wanted to say that those operating expenses would be don't forget this is the variable cost statement. So it would be the 27.3 operating expense plus the 14. So 27.3 variable and 14 fixed. Okay. All right. So your so our variable cost income was 37.4, and our absorption cost income is 36.4. So we must have had more inventory come out into cost of goods sold than what we produced. Okay. So just make sure that you do this one by yourself. Okay. They look straightforward, but when you're trying to pull the numbers out, the practice itself is good for you. Okay. All right.